Keeping it far away from my keyboard.
Yeah.
Right. Okay. We're on live. Just chat amongst yourselves for three minutes. I'm going off video. I'll see you all at the end. I'm here the whole time just in case something goes badly wrong. It never has, touch wood. And I'll count you in, Dominic.
Things do go wrong in webinars. I was once doing one at a hotel when a man in the street outside put a pneumatic drill through all the power and telecoms cables in the hotel. And we resumed this webinar on a mobile telephone, which is a very interesting experience. People did notice the difference. That's my worst experience.
Now somebody's buzzing my doorbell, but I think it's Amazon. So I shall ignore them. Okay, 2 more minutes. I don't think we've ever been this organized. I'm going by my computer, so hopefully it's on proper timing.
So Wendy, we need a countdown.
Yeah, I'm going to give you one, just a minute. Right. 5, 4, 3, 2, 1, start.
Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar, Digital Asset Custody, The Future Looks Like the Past. Our title in a way says it all. The Satoshi Nakamoto dream of unintermediated financial transactions between issuers and investors has got stuck on the undying preference of asset owners, if not asset managers, for somebody to look after their digital assets in the good times and make them whole when something goes wrong in the bad times. And they think like that not least because regulators, especially but not exclusively in the United States, where the biggest asset owners tend to be based, insist that institutional investors use qualified custodians. And if you're wondering what a qualified custodian is, look no further than the inaugural issue of Future Finance's Digital Asset Custody Guide, which you can download from our website. That guide has provided the inspiration for today's webinar, and the research behind it has suggested the topics we're going to discuss this afternoon, namely what institutional investors want from a digital asset custodian, how banks are responding to those needs, whether banks will displace or in some way supplement non-bank cryptocurrency custodians, whether regulators would actually like to see non-banks replaced wholesale by banks, and of course, last but not least, where the future of digital asset custody almost certainly lies, which is in the tokenization of an increasingly wide range of assets. To help us explore these issues, we're joined by 4 experts in the field, each of which brings a distinctive perspective to bear. Alex Kesh is head of digital securities and a member of the executive board at SDX, the digital asset exchange and central securities depository built by SIX, the Swiss exchange. Mark Meyerfeld is chief revenue officer at GK8, the cybersecurity fintech that helps financial institutions custody their digital assets securely, which was acquired in February this year by Galaxy. Kalesi Blundell is a partner in the financial services regulatory practice at Herbert Smith Freehills, where she advises banks, broker-dealers, and financial market infrastructures. Sean Mullins, a senior vice president at Northern Trust, has led digital assets and financial markets product implementation at Northern Trust since 2021. The task of Sean and his colleagues is to identify new opportunities and operating models created by emerging technologies, such as blockchain and AI. Our panelists are, of course, here to answer your questions as well as mine, so I encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of your Zoom screens. I won't save your questions and comments up to the end, but I will ask our panelists to address them as we go along. In that way, you, the audience, can be an integral part of this discussion right from the outset. I'd like to begin our discussion by asking each of our panelists in turn what it is that institutional investors really want. I presume it is, as I indicated in my opening remarks, to move seamlessly between cryptocurrencies, native tokens, asset-backed tokens, traditional securities, stable coins, tokenized deposits, and of course, eventually CBDCs. In other words, I think institutional investors want services that enable them to be indifferent as to whether an asset is digital or non-digital. My question is, how will custodians help them do that without getting bogged down in lack of interoperability between blockchain networks and between blockchain networks and conventional securities and cash networks? What services, in other words, well, to cut to the chase here, what services do custodians need to supply to their buy-side clients to give them that seamless experience? Could I ask Sean, perhaps you could address that first, and then Alex could look at it second.
Yeah, sure. And thanks, Dominic, for the question, and thank you for having me on the panel. Yeah, I think you've kind of hit the nail on the head, really. And that's not going to be my only answer. I will give a bit more background to that. But essentially, I think you can categorize what institutional investors want into a few categories. I think the obvious, which is not just exclusive to digital assets, you've touched on there. They want seamless integration. They want access to data and information, transparency. They want to be comfortable with the level of risk that's involved in looking after their portfolio. And that is not just exclusive to digital assets, but what we as a custodian have to do is we have to ensure that we're able to service a client's traditional and digital assets seamlessly in the same way and provide those same services. Now that's tricky to do, and unfortunately in the current environment, what tends to happen is you replicate a number of those records and services in the traditional environment. The approach we're very much taking at Northern Trust when focusing purely on digital assets, or digitization of traditional assets. I will go into crypto in a moment, but the approach we're really taking at the moment is looking at where the value is and looking at where we can incrementally change the operating model to give efficiency and to give that service to our clients. So one thing we're very conscious of is not standing still. So essentially, I think the way we tend to view this and our vision is that the assets being tokenized gives us an opportunity and gives us a green field where we can overcome some of the legacy issues we've got at the moment with regards to access to data and transparency and single source of truth. And then as a result of that, the life cycle that occurs after issuance, we're very much looking at what elements of that we can transfer to connect directly to digital, and we can digitize that in itself. So there's some easier ones, such as just reporting, and there's plenty of KYC and AML digitization tools out there that we can plug into and use. And then there's some more difficult ones like corporate actions, income and asset servicing, which will, without a doubt, will benefit from this technology and from the use of smart contracts. But that's going to be a difficult process to automate and to bring into the future. So yeah, as I say, I think the starting point is current services, and we're looking very much at how we can benefit piece by piece with our traditional operating model and ecosystem. I think the other side of that, and apologies, I'll just cover sort of the new asset angle. So crypto in particular, there's a number of services that go beyond just process efficiency there. And there's new products, and staking for one is the obvious one. I'm sure most people in the audience are aware we took the decision and to become a strategic investor in Zodiac Custody, which is a joint venture with Standard Chartered, who are a institutional grade crypto custodian. So one of the reasons behind that is it's going to be very difficult to follow the strategy which I just explained, and also satisfy our clients' crypto requirements. So we're very much looking at being able to do the old and new, and then my team's remit is very much about how do we integrate that together and provide that to our clients seamlessly.
Alex, you've heard what Sean had to say, that the difficulty of the transition. You've got one very large set of markets, you've got one rather smaller set of markets, but somehow you have to manage that transition. And I know SDX has a particularly distinct approach to that. So what's your answer to the question, what services you need to supply to enable institutional investors to engage with this market without complaint?
Yeah, as a market infrastructure, we need to ensure that there is liquidity access always, and that has been a challenge from the start when we build our SDX infrastructure, is that we didn't want assets issued natively on the SDX side of the world to be only accessible by SDX members, especially knowing that at the beginning there were only 3 of them. Now we're moving to 20, so it's better, but nevertheless, it's not the entire Swiss market. So for those assets to be accessible by non-SDX members, what we've done is build a link with the traditional CSD on the other side of SIX, SIS, to make those assets available to the entire Swiss market ecosystem, including international players using the SIX exchange and the SIX SIS traditional system. And the way is true for the reverse now. What we've built is a bridge between traditional infrastructure and our infrastructure to ensure that we can now start tokenize any assets that is traditional and make them available in a digital form to start benefiting from the advantages or pros that we see in blockchain, which is composability of transactions, atomic settlement for contemporary risk-free transactions, and so on and so forth. And the list it is long. We know it's only a first step because the journey is probably a 10 to 15 years journey to be fully transparent before the vision you just explained and that we share of everything tokenized happens. But we need to do it in a way that is acceptable speed to our members, and also in a way that does not disrupt the market. At the end of the day, people want to buy and sell assets. They're not interested in the underlying technology. They want to do that in the most efficient way. We can enable efficient ways with blockchain technology, but it has to be an enabler, not a something in itself. I will just add that on the crypto side, we also offer custody of cryptocurrencies at SDX on 2 separate businesses today, because on the regular point of view, those things are not yet together, but we anticipate that they will be together. We anticipate that those 2 worlds of digital securities, being native or tokenized assets and crypto, will coexist on the same infrastructure in the long run, will need to be reported in a similar way, will need to even potentially be swappable with one another, why not? And that will be an important aspect that we need to look at, including cash, and that we will discuss that a bit later, but a risk-free asset as a settlement asset for those transactions to happen.
Now, we've already had our first question, which I'll come to in a second, but Mark, you've heard both Sean and Alex talk about the difficulty of the transition. You've got an established set of customers in established markets where transaction volumes and values are very high, and on the other hand, you've got this relatively small and potentially massive opportunity in the long term, but you've got to somehow keep the customer satisfied over a 10 to 15 year transition. And in a way, the global custodians could kind of ignore the cryptocurrency market. Most of them, they had a few clients who were interested in that, but for the most part, they could ignore it because the size wasn't there, the interest wasn't there. But with tokenization, the problem is much bigger. But you're coming at this, I guess, from a cryptocurrency beginning and mutating into an institutional, conventional world. What would be your answer to this question? How you keep institutional investors engaged?
Yes, actually, well, a couple of things. First of all, we're an infrastructure company and we do support, obviously crypto is a large use case in our portfolio, but tokenization is, of course, a massive opportunity for us as well. And we fully support both token issuance as well as supporting existing smart contracts that are up on the blockchain already. But I think the area that I think institutional investors are looking for, it comes down to start with is the security layer. And they've got to be sure that the custodian, whoever's holding those assets, are actually properly securing that solution. And again, depending on the use cases that customers are using, they're going to want to have deep cold solutions in order to custody the assets for longer term. They need warm wallets for potentially doing other aspects of trading and tokenization, staking and DeFi, which Sean mentioned, or staking he did. And the security aspect is the first layer. The second layer is the governance side of things. I mean, one of the things that we have a very sophisticated policy engine that really allows, depending on the size of the institution, whether it be a tier 1 bank, whether it be a small fund or a protocol potentially, all of them have different ways of building their policies, whether it be quorums of approvers, whether it be who can actually interact at what point, whether it be account structures of omnibus or segregation of accounts, depending on the regulation. And all of those aspects come into the governance and even the deployment aspect. All right, there are certain jurisdictions that we're working with that require that all the private key material stays within the country, where it can't be in a multi-tenant environment. It's actually be provided, stored by the bank itself or locally in the country. So whether it be the UAE or Turkey or Thailand or other jurisdictions, and we believe also the US is going that direction as well. It's just a matter of time. So the full solution, the technology stack has to support a wide array of things. Now in the crypto space, and really across the board, it needs to be frictionless for the institutional investor. It can't be, it has to be easy for them. I think Alex mentioned this as well. All right, they don't really care. All right, they don't want to know about private keys for the most part. They want to know it's secure and they want it to be frictionless. They want to be able to work the way they do in a fiat world in the digital asset space. And that's ultimately the goal of everyone. We need to make this as easy as possible for the end user and provide the widest array of tokens, whether it be tokenization of traditional assets, whether it be coin diversity in the crypto space. Again, that's one of the things we pride ourselves, generic support for EVMs and smart contracts. Those are all aspects that are required in an infrastructure play that we see in the institutional space.
Thanks, Mark. And I've got a second question in now, which I'm keen to get to. But Kilesi, I wanted to give you a chance to give us your thoughts on this process. Mark alluded to jurisdictional differences here, which
absolutely
are opportunities for people.
No, so I think that's all right, isn't it? I think institutional investors will absolutely want diverse portfolios as they have today, but I think custodians will have a choice. Do they develop platforms and systems as just described now that cover all sorts of assets, or do they focus? And I think from a regulatory perspective, there's been quite a bright line drawn at this point in time, at least, between two broad categories of assets. So you've got cryptocurrencies on one side, which in the UK and EU at least have been stated to fall outside traditional regulation. So we've had to look for new solutions. So in the EU, we've had MiCA. In the UK, we're looking at all sorts of solutions, and lots of those are in consultation right now. But on the other side of things, when you're looking at digital securities, those assets are, and it's been stated by regulators, should be regulated as traditional assets are today. So if you've got a digital bond, then that should be regulated as it is today, whether or not it's a representation of an existing asset or a natively issued token. And so that means from a European perspective, you need to think about how MiFID might apply, and in the UK, how the Financial Services and Markets Act and related conduct rules, including potentially CAS, might apply. And it's well known that that's a challenge. And so we've seen various responses from regulators. In the EU, you've got the pilot regime. In the UK, we've got a digital security sandbox, which is starting to look at modifications to the existing regime to allow market players to develop platforms in a safe environment and work out how the regime may need to move on. Custody and the CAS rules at this point, don't fall outside the scope of the pilot regime because that's a national matter. In the UK, there's a bit of an open question how broad that sandbox will be.
Thank you, Glaze. That's a good point. If we're going to get this seamlessness, this kind of convergence needs to take place not just at the operational technological levels, needs to happen in the legal and regulatory level as well. And with cryptocurrencies outside the regulatory ambit, that's quite difficult to pull off. Now, I'd like to, Andrea Tranquillini has asked a question here, in which he says, on the bridge, by which I think he means the transition from the world we're in now to the world we're going to be in the future, how do you handle the higher complexity of digital assets in the de-tokenization? And I assume, Andrea, I'm sure you're listening, you mean by that the traditional custodian bank has to master all these new forms or these new responsibilities which digital assets give you, like atomic settlement, like airdrops, like staking and automated market making, all these sort of things. These are indeed the new forms of custody, the HSM, the multi-sig, and the MCP or MPC. And I guess, Sean, and maybe Mark, you've got some thoughts on this, and so have you, Alex. I guess, Sean, you've been dealing with this for real. How do you handle that high complexity of digital assets as you're transitioning from the world we're in now to the world we're moving to? Andrea's written to say it's very much Alex to manage the SDX6 link. So, Alex, think about that while Sean gives us his initial thoughts on the bridge.
Yeah, sure. I was going to be cheeky then and say feel free to go direct to Alex, but no, I'll
okay. Sorry.
I'm happy to do that.
I was off the hook, but no, I think I do have a tendency to oversimplify these things, right? But I think when you're looking at what we do today and what we're looking to do in the future, there's a lot of similarities, right? I think if you're de-tokenization, so I don't know, I'm not sure if you're referring to the tokenization of a traditional asset that's represented traditionally and then winding that back, that's very much like unlocking collateral today, for example. And I'm not sure you'd want to do that because you get the liquidity from it being tokenized. But again, we've got these frameworks, we've got this architecture in place already, and it's just a case of using them slightly differently for new products. I think the key thing that comes into question there is what Mark's mentioned previously. We still have to tick a lot of the traditional boxes. We still have to define roles, market access, account structures, data security. We still have to go through all of those things. So it's one thing, everything looks simple on a whiteboard, right? And then when you look at how the steps you have to overcome to actually do that, that's where the difficulty is. So how you overcome that piece, I think I touched on this earlier, you just have to keep moving forward. So at the moment, some of the digital asset custody use cases we're looking at are well scoped, well understood, and relatively simple. Privately permissioned networks, for example, where we're playing around a lot in those. The key management is not as imperative in that environment because you control the permissions and you control the environment itself. And then also the asset types we're looking to tokenize as well. That is also, we're sticking on the relatively simple side to learn and explore and evolve and deal with those difficulties as we progress. I fear if you try and tackle all of those now, if we as Northern Trust tried to provide a staking solution directly that was alongside our other capital markets products, we would get so bogged down with analysis, regulatory frameworks, permissibility, that we just wouldn't ever move forward. So long story short, we look very much at what we do today. How does that apply to what we do tomorrow? And what are the easy next steps we can take to continue moving forward?
So Alex, tell us how the SDX6 link works.
Well, that's an easy one actually, because we apply exactly what Sean mentioned, which is an existing framework, which is a CSD link. So SIS, which is the CSD in the 6 group traditional side, and SDX, which has a CSD license on the SDX side, the depository license, have established a link like they exist between SIS and Euroclear, between Euroclear and Clearstream, between every CSDs that are out there pretty much. And that enables assets to be held into the account of the issuer CSD and be then reissued or made available in the investor CSD where the investors are. So it's a very similar module, going both directions. And that enables us to do what we need to do around tokenization within the existing regulatory and known frameworks in a way. That becomes, of course, more complicated when we will start, and we are looking at public chains. But we could imagine similar bridging, and we've started discussing with banks, and actually I would be interested to talk to Sean after this call about a bridging tokenization platform, because what we see happening is a lot of islands of tokenization being created by various banks which do not necessarily talk to one another because of different technologies, because of different setups. And as an FMI, which is a multi-party type of infrastructure, by definition, helping multiple banks talk to one another, we are in discussions to bridge also tokenization platform with our infrastructure to make those isolated tokens, bank tokens, if you wish, available to the entire Swiss market. So bridging is not only about traditional and tomorrow, it's also about today's tokenization and blockchain infrastructure, which unfortunately are not fully interoperable yet, except in the Ethereum world with EVM compatibility and so on and so forth. But we're not there yet with many of the chains.
Now, Kalesi, one of the points which Sean made is that you have these traditional custody frameworks in place, so you kind of know what to do when you're dealing with a digital asset almost from first principles. Yet when we look at some of the accidents which occurred in the cryptocurrency markets, and I'm thinking of FTX here in particular, those traditional custody practices like separation of duties, segregation of customer assets, were not actually in place. And I'm now looking at a question here from Nipan Rajan, and Nipan, do expand on this if I've misunderstood what you said, but your question is, talking about DeFi and asset tokenization, how do you navigate the potential opportunities amidst framework ambiguities? And you yourself, Kalesi, you pointed out that cryptocurrencies are outside regulation at the moment in pretty much all the major jurisdictions. Alex has brought up this question of public versus private blockchains. You've got dozens of blockchain protocols, and then you've got the way in which these assets are serviced varies hugely between cryptocurrency and traditional world. So when Nipan is talking here about framework ambiguities, he's actually talking about an awful lot of different things: law, regulation, operating procedures, habits.
Yeah, absolutely. And I think actually the FTX failure is actually a really good example of the kind of difference of the two worlds I started to draw out. So as you've said, that was an example of in part, cryptocurrency essentially. So very much different from the traditional assets world. And in the case of FTX, we didn't see appropriate governance or any of the kinds of rules and regulations and procedures that traditional custodians up and running today adhere to. So I think it's very much a driver, I think, in both worlds to ensure that those standards that we know are safe and effectively and ensure effective markets are carried across. So we are absolutely going to see increased, I think, requirements for the holding of crypto assets, including cryptocurrencies. So I think the ambiguity in that space will diminish over time. At this point, the regime in the UK is still being developed, so we will see. There's lots of open questions on what that might look like. So I think it's a watch this space. The other ambiguity, though, is the one that I was describing in the traditional world, where it's all very well to say that tokenized security should comply with existing rules. But when you take a novel structure, a new platform, and you try and marry the two things together, you come across all sorts of difficulties. So again, that's why you have those experimental regimes such as the pilot and the sandbox here in the UK to just try and work out what those ambiguities are and how they should be addressed going forward.
Kalesi, can I ask a very unfair question just before Mark chips in? Do you think the regulators in North America and in Europe and in the UK and possibly in Singapore and elsewhere as well want banks, regulated banks, to take over digital asset custody? Do they actually want these non-bank custodians to survive? I mean, we see in stablecoins, for example, we see it's a very clear policy across all the major markets to say we want banks. to issue stablecoins if they exist at all. And quite frankly, we'd prefer if it was tokenized deposits. I have a very clear view on that. It's the same here, digital asset custody.
Yeah, so I think it will depend on the asset class, right? So with stablecoins, that makes absolute sense, doesn't it? You need to be linked to a fiat currency. But I think if you look at the FCA, for example, they are absolutely pro-competition. That's reflected in all sorts of kind of experimental spaces. There are called sandboxes here that they set up. So not just the one I've mentioned, there are tech sandboxes too, where they're very keen to see how new entrants might operate. But having said that, the trend that I mentioned earlier, I think is very much a real one. It's all very well that you may be a new entrant, but over time, I think we will see that those new entrants do need to comply with rules that perhaps banks are more familiar with today.
Mark, you were going to say something. I'm sorry, I hope you remember what it is.
Yeah, no, of course I do. So yeah, I think both Sean and Alex touched on something that, I mean, we have a pretty strong view regarding private blockchain versus public blockchain. I mean, to the extent that private blockchains, we don't even consider to be a true blockchain. The security layers of a private blockchain are quite different. And Sean touched on it. You don't need really to manage the private keys in the same way. It's not decentralized in the same fashion. And when it comes to interoperability, which Alex touched on, the need to do this on public blockchains is evident. I mean, the ability, and yes, it does need interoperability, but the ability to do that in a public environment on a true blockchain with the security layers is key to really having tokenization pick up across the globe.
If I may jump on that one, I fully agree with you. I guess the challenge is time, right? When we started SDX 4 years ago, actually 5 years ago, the only solution that a regulator would have accepted for an exchange and a CSD running on blockchain was private blockchain. So yes, the future is likely to be public or a mix of both types of infrastructure, hopefully interoperable, but it needs to be somewhat seamless, and as you mentioned earlier on, and it is not today. It is islands of implementations that don't talk to one another, and that's critical to change. And I think it will be requiring collaboration among all the players in this industry to make sure that it happens. Again, for the benefits of the only two entities that matters in this world, the issuers and the investors. We're just in the middle trying to make their life better, but they are the two entities that matters.
And you can see from a regulatory perspective why it's much easier to regulate an environment that's very controlled and a private environment. And so if you do open things up, all sorts of challenges will start to arise. Conflicts of law, where are people based? Who's actually able to control and where's the effective governance? So all sorts of difficult questions start to emerge as things develop.
Now, Mark, just to go back to the question of whether non-bank cryptocurrency custodians, I'm thinking here particularly of the ones which are owned by the cryptocurrency exchanges. I mean, our survey identified more than 100 institutions offering digital asset custody services, of which an increasing proportion are regulated banks, a little bit less than half of those. There's an awful lot of organizations out there offering a cryptocurrency custody service. And we see some of them trying to respond to institutional money by doing things like taking out insurance policies. So if they lose your asset, at least you will be made whole again. We see them taking on some of these third-party certifications, things like SOX certificates and ISA certificates. I mean, how do those compare with just being a big fat bank with a large balance sheet? I mean, are they credible responses if you're an institutional investor, do you think?
So, I mean, there's a mix. I mean, you use the word regulated. So obviously, if these are regulated institutions and they have the proper infrastructure, somebody like ourselves, which are SOC 2 Type 2 compliant, we have the largest insurance available in the market, which is up to $1 billion of insurance per vault per customer, which is a huge amount in the space. Those are all things that, as long as the non-bank and the traditional custodians, as long as they abide by the appropriate governance and the appropriate setups, there's a place for them in the market today. I mean, you have that in the traditional space. You do have banks, and you have other firms, FCA, all different types of firms in the traditional finance world, and it doesn't have to be only the traditional banks. Obviously, when it comes to institutional investors, the natural place that they're going to want to leave their assets are in a place that they, from a name brand and a security perspective, in their minds, it's going to be with a Northern Trust, with a Bank of New York, with a large institution that they can actually rely on. But it really comes down to the expertise and how it is actually managed. And as long as the regulation is checking up and actually ensuring that the assets are secured properly, that the policies and everything else is in the proper way. You mentioned SOC 2 Type 2 certification, whether it be FIPS 140-2 on the HSM side of things. These are all things that need to be covered. And as long as that's done, there's a place for both the non-banks and the banks in this space.
I probably made it sound as if a bank is always the best answer here, but we have, of course, had recent experience of banks themselves falling over. We've had SVB, Silvergate, and Signature Bank. Admittedly, they were custodying cash, which, oddly enough, regulation had kind of driven onto their balance sheets because respectable regulated banks, as it were, weren't able to take on that business or didn't feel comfortable taking on the business. They were discouraged from taking it on by regulation. So we have had banks which have failed, and Kelechi, I'm sure you've got some observations on that. But when we first started to look at digital asset custodians, we were kind of surprised to find that, in fact, we couldn't find a single instance of an independent third-party custodian who'd actually lost customer assets. Now that did actually happen in June this year with Prime Trust, where a gap between the assets and liabilities of more than $80 million did appear when the firm went into liquidation. So we now have actually had a loss occurring in a digital asset custodian which kind of grew out of the cryptocurrency sector. So where does this leave us? Kelechi, perhaps I could start with you. Those banks that failed, what impact have you seen that have on the attitudes of investors towards the type of bank they use? And indeed, what impact has it had on the banks themselves? And Sean, I'm sure you've got some observations on this too, if you'd like to chip in. But Kelechi, what's your thoughts on what impact those failures have had?
So I think, post-financial crisis, the world at large is aware that banks fail from time to time. I think this round of failure perhaps took people a little bit by surprise. But I think it is right that in certain circumstances, a bank should be allowed to fail, and the business model, should be tested. So in many respects, I think it's not a completely unheard of event. That said, I don't, and SVB is a particular example, right? It was a bank exposed to a particular population of depositors who did tend to be connected. We know now that really maybe certain capital requirements hadn't been integrated in a way that we'd expect at an international level. There's a whole variety of questions there. But I think for depositors, the general thing that keeps people happy are the deposit guarantee schemes that exist around the world. And so one area of discussion that's come up is what's the appropriate level. So in the US, that's $250,000. Here in the UK, it's 85K. So your first 85K is protected and will be topped up by the scheme. So I think there's a question of, is that an appropriate level? Should it be more? That's just one of many questions. But I think people generally continue to trust their banks.
Well, I'll come back to you a bit later because we're talking here about cash, but later we'll talk about securities and we'll talk about the efforts of American regulators in particular, actually, to put those assets on the balance sheets, which transforms the custody business from being a pure fiduciary to actually being principal risk. Mark, did you feel Prime Trust changed the atmosphere and has kind of condemned cryptocurrency custodians to a slow attrition?
No, we're not seeing that. I mean, obviously, I think the market is a very strong market. We've gone through quite a bit over the last year. Yes, Prime Trust, while it did put a bit of for about a week, a little hindrance with regard to what people think of these custodians.
Financial markets, yeah.
That's for sure. But again, we haven't seen that stop. We see that from a security perspective, people want to actually get better with regard to how they're managing digital assets, and they want to be sure. All right, people are checking out more who they're putting their assets with. And a lot of the traditional custodians that are out there today, the security layers that they have are really not that good. Right? Sadly, I'm very familiar with some of the solutions that are out there in the space today, and people would be shocked at the way they're being managed. Now, they're trying to get better and they're trying to harden the space, and that's where, again, the regulation needs to come in and put their foot down. I mean, Prime Trust, okay, was a single example. You had FTX, you had others in the past that have gone through. And Dominic, I mean, you mentioned that this is the first time people lost assets. Not quite true. I mean, there have been known hacks in the space.
Independent custodian, I meant.
Okay, yes, absolutely. Because there have been quite a few hacks in the space, even of the traditional the digital custodians that have taken place. And again, if the proper insurance and proper aspects of the solutions are in place, these things can be mitigated.
Yeah, maybe I can jump in there, having been on the crypto custody side of things and in the digital security side of things now. I think we shouldn't confuse both type of assets. So for cryptocurrency, native cryptocurrencies, obviously there you need the optimum security to ensure that those assets that when you send them to the wrong address are lost forever are not lost. And if they are hacked, they can't be hacked. For tokenized securities, it's a different story, because when you issue a tokenized asset, you can define in the smart contract how you want to control who has access to that asset, how to control what happens if something goes wrong, what happens if there's a fork, what happens if someone is managing to take those assets into a wallet where they're not supposed to land. You can freeze them. That happens as well for stablecoins. So this is different. So we shouldn't be comparing the two too much. It's based on the same technology, but the level of security and cybersecurity is not completely the same. Of course, although you don't, as an infrastructure, for example, SDX, you don't want to be disrupted by a hack or a cybersecurity incident, even for tokenized assets. But that's something I wanted to mention. And on the insurance side of things, as much insurance are great, you still the premiums that you have to pay to get that insurance are very high. It's between 1% and 2% annual premium, and that kills your custody business case in most of the time, because you don't charge that much money to your customers for custody. So it's a complicated matter, and I agree with you that I mean, let's first focus on the security, on the infrastructure, and making sure that you also leverage traditional custodians or traditional FMI's experience in managing assets on the governance side of things.
So Alex, I mean, just one thing that you mentioned, like, first of all, I do agree with you. There's a difference between tokenization of assets from a cybersecurity perspective as well as crypto, but it's different. In other words, it's not that there are no cybersecurity. I mean, I'll give you a couple of examples. All right, understood. People don't focus on how they deploy smart contracts, how they issue the token. All right, if they're issuing it from an interconnected computer, that smart contract, whether you're auditing or not, you're putting a level of risk there. Being able to deploy that solution in the ultimate, meaning offline, and actually deploy that smart contract in the proper way, that's the first part of it. And then you have things like the admin keys with regard to the smart contract. All right, if somebody gains control, can actually mint tokens or burn tokens on your asset, then those are very important things that, whether you're using a stable coin, whether you're using a tokenized bond, these all need to be focused on. And with regard to the insurance, I couldn't agree with you more. I think the importance of having the insurance from our side is really the fact that the insurers are willing to give it a level of insurance like that just supports the level of security that we offer. In other words, you're right, the premiums are tremendous. It's exactly. So the fact that they were willing to give us $1 billion of insurance says to the customer, saying, you know what, this solution has been checked and it's fully secure. Because you're right, the premiums are pretty significant.
Now, Shuta Okawara has asked a very interesting question, which I don't want you to address just yet, because I'd like to go back to the regulatory question. Before I do, Sean, did you want to chip in on this Prime Trust SVB bank, whether you've seen that has changed attitudes, whether people think differently about who to appoint as their custodian? Now, I'm talking here about asset owners, really.
Yeah, sure. I'm not sure it's had the impact that people think it would have. To Mark's point, and I think Mark and Alex, the exchange they had there is really a clear sort of indication as to the situation we found ourselves in. We're having to do a lot of education on what it is that we are providing and how we're dealing with that. And also, there's a lot of comfort with an organisation like Northern Trust. with the reputation, the history we've got, is that flight to safety. And Mark, you mentioned about all of those security controls. We have to go through all of that info security with everything we do, not just digital assets. I mean, our cloud strategy has been painful, right? For those reasons that we have to keep on ticking all those boxes and ensuring that we've got the utmost security and data segregation and so on. So yeah, I would say the impact really has been education, because some of those collapses are not really to do with crypto or digital assets. It's kind of bad strategy management. And really as a result of that as well, and speaking to our peers over at Zodia as well, they're in exactly the same boat, right? And that they're actually, not that this benefits them, but obviously being sort of that institutional grade, that's the angle they're coming from. They're able to comment on and reassure people that look, this is traditional custody in its security, its most secure sense, but we're able to apply that to digital assets. So yeah, education has been really the key behind that, but overall no real change in attitude.
Now, Kalezi, before we turn to Shuta Okawara's question, could I ask you to make some observations about what's happening on the regulatory front? And I know this is slightly unfair because it's really emanating from the United States. As I said at the outset, the United States, through the ERISA Act, through the Investment Company Act, kind of shaped the global custody industry as it emerged, because they expected asset owners and asset managers who were looking after assets on behalf of third parties to appoint qualified, respectable custodians to look after those assets. Now we see some very interesting, potentially disruptive steps being taken by the SEC, especially with this staff accounting bulletin. Its regulatory status is not entirely clear, but SAB 121, that obliged digital asset custodians to put the customer assets on the balance sheet. You've seen that happening with crypto asset custodians. They're now proposing these changes to the Investment Advisors Act, which will oblige them to put these customer assets, digital assets, into segregated bankruptcy remote accounts that have to be audited annually, and they'll have to be prepared to indemnify clients against those losses. Now, reading those changes as a European, they reminded me very much of the debate we had 10 years ago around AIFMD and UCITS 5. Would custodians be responsible for losses of customer assets, however those were came about, even where they didn't control the assets? The assets were with a prime broker or in a CSD or somewhere else. But this does change the custodians. Custody has been off-balance sheet fiduciary business. If the bank fell over, the assets were not part of the bankruptcy. It was a fee-earning off-balance sheet business. That's what made it attractive. What's your take on how this is changing both sides, the asset owner side and the global custodian side? They're starting to think very differently about the risks of this business, are they not?
Yeah, so I think from a custodian's perspective, I mean, this is a surprising, so the requirement to hold assets, client assets on balance sheet, surprising development, particularly from a prudential perspective. So if the requirement says you need to hold capital against all of these client assets that you hold on an on-balance sheet basis, you can see that for the largest custodians, that just may be financially unfeasible. How on earth could they afford those capital requirements? So there's a real central question, I think, to where this potentially new approach goes. And I think it shouldn't be underestimated, the potential impact it could have on the market. But I think just staying with that prudential thread, the approach that you've just set out in those US regulations isn't the approach that we've seen proposed by the Basel Committee on Banking Supervision. There we very much see the off-balance sheet approach being retained, which is positive, and one that I think the market in general supports. But I think it's a point that should be monitored very carefully, particularly here in the UK and the EU, as the rules are developed, because there's just lots of open questions, and we just, I think, need to be aware of potential consequences of some of the fundamental changes in approach.
So we think this is a US specific. It really is
We
going
hope.
at work here.
Yeah, we hope.
Yeah. Okay. So it's not part of a secret plan to drive all business to these regulated banks and keep things the same.
And it's interesting you say that, though. So you mentioned AFMD and UCITS. In those bits of regulation, we do see some requirements for a particular type of entity to perform the depository or custody role. And those entities are generally regulated banks or certain types of investment firms, or in some circumstances other institutions. So there are in outside prudential space some requirements and regulation that do mandate a particular identity of custodian for a particular type of asset, and I expect that will continue to be the case going forward.
Okay, let's deal now with Shuta Ogawara's question, and he's addressing it really to Alex, but I think all of you will have something to say about it. He says, Alex, you're no stranger to standardization and harmonization across markets. That's a reference, I think, to your long career at Swift before you moved into this sector. How do you envisage interoperability collaboration being achieved across asset classes and across borders and regional jurisdictions? And I think this opens up a whole set of very interesting issues. But Alex, what's your first response to that? Is this a Swift production, or is it something completely different?
Yes, hi, Shuta, who I know. Of course, it's. I think it depends. Yeah, there are different levels of standardization, harmonization, and interoperability. If we're talking about the usual, the data models, for example, that are used today in the financial industry, leveraging existing protocols such as FIX for trading and ISO for post-trade, these things don't need to change. It's not because you're creating a digital securities that suddenly it's a trade date is no longer a trade date, and a set and an attribute of the financial instrument change names or change definition. So in terms of data definition, data model, we are at SDX, we're using ISO 20022 as a source. No reasons to change, and that enables interoperability with traditional finance as well. But there is a need, of course, for more of those data standards. There's one called the Digital Token Identifier, ISO 24165, which identifies uniquely with a fingerprint, meaning the source, blockchain source, and some unique feature of that token to ensure there's no issues in distinguishing your tokens from another token, and those standards are critical for the future harmonization and adoption of this technology. And then, of course, there's the old technology harmonization and the EVM compatibility like type of standardization that will be definitely required. There are experimentation happening in that space. I can mention one, which is the Swift Chainlink one, which was an interesting attempt to see how do we, in this transition towards this vision that we just described at the beginning of the session, how do we enable the old world, between brackets, and the new world to seamlessly interoperate without necessarily having to trash everything you have today, and reusing Swift connectivity, reusing the processes that you have in place. Is it perfect? Probably not, but it's a nice attempt to look at this interoperability challenge that we will all have to look at collectively, not as individual firms, in order to be successful, to successfully reach that vision.
Sean, do you have some thoughts on this? And I'm asking you because you've just heard Alex say you won't have to throw away your Swift engine just yet, but there is also this parallel standards adoption, production and adoption process going on. But if we look at the entire history of Swift, it's been a struggle to get standards adopted. In the securities markets today, we have people using at least 3 different versions of Swift standards. We have them refusing to do what their payments colleagues have done and moved to ISO 20022. And perhaps I'll explain in a minute what I have in mind here as an alternative. But what's your answer to Shuta Ogawara? Are we going to be here for decades trying to get people to harmonize and standardize, or is there a quicker path?
Unfortunately, I'm quite cynical when it comes to this. We was involved in an experiment with Swift last year where we looked at how we could instruct creation and movement of tokens across systems using Swift. And there's a lot of good that Swift has already done that can be reused. I think with regards to the interoperability and collaboration, it's definitely happening, and it's happening in the right way with how it's evolving. I think the key question that we're really trying to answer is, what does that future look like? Who are we going to need to be interoperable with, and who are we going to need to collaborate with? And I think that's the difficult bit there, and that's where the question mark lands. So I wouldn't want to be on the other side of this with Swift trying to second guess that and trying to create and implement standards. And unfortunately, I think it would follow like a typical sort of hype cycle, right? I think there'd be a lot of people that would try and do this, and essentially there'd be a few survivors that get mass adoption. And if I knew who those were, well, I'd be putting my money in that direction, definitely. But yeah, the cynic in me says this is going to be a long time coming, and there will be some winners eventually. But until that point, I think the existing frameworks will be used.
It will take a long time, Sean, but we kind of have to start somewhere. And Nipun Rajan has asked a question which prompts a thought in my mind. What he says is tradability and liquidity is a big issue with real-world asset tokenization. How can this challenge be navigated? To some extent, it takes us back to the bridge, the transition question we were talking about a few minutes ago, how we get from where we are now to where we want to be in future. And I'm thinking, is that, we're kind of taking the path of least resistance here. You've got these assets, I don't know, privately managed assets, real estate, which don't have the infrastructure, standardized infrastructure, which equities and bonds do. And people have identified those as an early use case for tokenization, I suppose. Do you think that is the right path to be going down? I know that Northern Trust has done some quite early work in this area. Or do you, as the cynical side of you, feel we actually need to do something much more radical here?
No, I actually do think that is the right path. Yeah, so I think the way we very much approach these sort of innovation opportunities, we look at where we want to end up, and then we look at what's the first few steps on that journey. So we're not into producing 2-3 year roadmaps, right? Because in a year's time, you're going to learn so much and everything's changed so much, you can rip that up and start again. So we're very much about, we know where we want to end up, and we've got a good visual around how we see the future asset servicing ecosystem, fully decentralized. And I'm not sure when or if we ever get there, and we're looking at what's the first steps on this journey. And I mentioned it earlier, we don't want to become paralyzed by analysis. We want to keep moving. I do think we're at an inflection point, or at least approaching that now, where there does need to be a boost or a kick or a leap of faith. To Mark's point, we've been playing around in privately permissioned networks for so long now. There's only so much benefit you can gain from that. And we really need to both make sure that the regulators are comfortable, that organisations are comfortable, that the knowledge and understanding is there to implement and do that correctly. And I think that the tradability and liquidity, they're not issues, they're opportunities, right? If you get tokenization right, it opens up liquidity, it opens up secondary markets and tradability. Fractionalization lowers the entry bar to asset classes that are not accessible today. So yeah, I think they are not issues in their own right. I think getting there is the issue. And yeah, small steps is absolutely the case. But Dominic, if we're talking in 2 years' time and we're still looking at privately permissioned fixed income bond, then I'll probably say we've stalled, right? And we need to try and work out to move forward.
Yeah, Sean, you actually hit a good point. I agree with you regarding liquidity. If you get it right, the liquidity is going to be significantly better here. I think one of the biggest issues in the industry is everybody's so broad with regard to talking about tokenization. I mean, the word tokenization, okay, you could tokenize a bond in money markets, foreign exchange, equities. There's so many assets. I think until the industry gets a focus and says, okay, we're going to start with this asset class. We're going to get the top 10 players in the space focused and get together in a room and agree on certain standards. And this is how we're going to start on a particular asset. I think that's the only way to go forward, because otherwise, I hate to say it, we might be here in 2 years' time still talking about the same issues.
We're into our last 3 minutes now, and I'd like to wrap it up by asking each of you to give me your observations on the question. And in a way, it takes us back to the very beginning. This webinar is about the fact that asset owners and asset managers actually want to outsource custody, partly for their own reasons, partly because the regulators ask them to do that. My question is really, is a future in which custody can be done in-house by the buy side actually conceivable? And I'm referring here, I think, to a fully tokenized, a native or genuine tokenized future, in which all the assets are genuinely digital. They're not available in their analog forms anymore. There are no analogs available, if you like, of assets. And all forms of capital raising, capital trading are taking place on, and this is a term I owe to the Bank for International Settlements, which is a reputable source, a single programmable platform. In other words, we have these blockchain networks, if you like. They might be public, they might be private, there might be all sorts of things. But they will be a single operating model by which all types of digital asset are issued, traded, settled, custodies. And they're all joined together. It's a kind of network of networks, which becomes, in practice, a single programmable platform. So every asset is treated exactly the same way. And this intrinsically solves your interoperability problem, because everything is interchangeable, because it's exactly the same type of thing, irrespective of whether it's a debt or an equity or a commodity or whatever it is. So if we arrive at that sort of model, do we think that institutional investors still need to outsource custody? Do we still need this paraphernalia of custodians, fund accountants, transfer agents, and the rest of it, which we have today? Can Nakamoto's dream be ultimately achieved and deliver all the benefits which have been talked about so much? Sean was talking about them again there, about cutting costs, transaction costs, fractionalization, etc. Alex, what's your answer to that question?
I think it's yes, meaning that yes, there is an opportunity for having the assets the closest to their owners, and that means individual owners or asset managers or pension funds. But many of them will still want service providers to help them with that. It's not because they cannot do it themselves, it's just because it's not core business for them, and maybe they don't necessarily. It does not necessarily allow them to offer financial innovations that intermediaries could still be providing by sitting in somewhere in the middle and being able to combine those assets together as a block, as a combined collateral basket for a specific transaction, financing transaction, for example, and so on and so forth. So I think there will still be banks in the future. There will still be custodians, but there will be more choice of how you want to manage your custody. And as an FMI, there will still be also FMI in the future. Some people have said that CSDs will disappear with blockchain. As they are today, probably they will, but you still need, in an organized market, to have someone managing a trading module on the blockchain, a lending module on the blockchain. And the way I see FMIs of the futures is they will be the institutional Uniswaps and the institutional Aave of this world, making sure that things works properly, that it's multi-party, that it's working according to law and regulations, and that are there when something goes wrong for the regulator to call or for dispute resolution.
So, Mark, the existing intermediaries will likely survive even in a pure tokenized model, but they'll probably be doing slightly different things. Is that a future which you see as plausible?
Yeah, I mean, also when you touched on the buy side, I mean, there are different types of buy side institutions, meaning you have some of them that are sophisticated enough, large enough to be dealing with potentially managing their own private keys and their own assets, and there's benefits to that. But a large portion of those, that's not their business. They want to deal with what they're experts in, and they want to have the security layers being managed by a bank or by another financial institution that can actually secure the assets, and they can deal with earning money and other aspects. Now, there is an aspect of providing control to the buy side user. In other words, there's a difference between whether I'm actually holding the private keys or whether I can potentially give my customer an ability from a policy and application level to say, okay, I'm the only one that can actually move those assets or move those funds. Without an approval from me, nothing happens. So there are ways of giving control to the end user without them necessarily being the owner of the private key from a regulatory and a custodian perspective. And I see a world where you're going to see a little bit, it's going to be a little bit of a mix. There's never going to go away. You're still going to have some of the large players that are going to manage their own assets, but clearly the banks are going to come into the picture strongly.
Kelechi, what's your take on the future here? I've tried to outline a vision of something where the infrastructure is transformed because you've got this single programmable platform. People have to fit into that, provide useful work, value add within that. Am I being too futuristic here?
No, I think there's absolutely going to be continuing a need and a space for custodians for many of the reasons we've touched on over the session. So there may be regulatory drivers, but there are also the insolvency remote benefits of using a third party sometimes to legally hold the title to your asset. So that trust relationship has got real benefits, and even on a platform that will continue to be the case in certain circumstances. So I think how things are custodied and how custodians and maybe even who those custodians are may develop over time, and it probably will. But I think custody will absolutely remain a service that's required and needed.
We'll have to come back to you, Kelechi, to talk about the UK Law Commission report, which describes these assets as digital objects. And
wow. Yeah, are they property? Are they custodiable? Okay.
Yeah, that is a very interesting question. I can see Sean has been curled up at night with the Law Commission. Only 1,000 pages of it. But we'll come back to that at a future webinar. But Sean, a last word from you about the big opportunity for a custodian like Northern Trust here must lie in tokenization achieving scale. And we've talked about some of the paths to that. We've talked about how long it will take. But what do you think Northern Trust will be doing when we reach this new world? Is it going to be roughly the same as you're doing now, or will you be doing lots of different things, or is it too difficult to say?
I think the everything that the group has said is absolutely spot on, and we're in agreement with that. I think when we look at that vision of what this could be, and then as a sort of innovation background that I've got, I look at that and think, well, that's amazing. And then our advocacy leads come in, our network management come in, our legal team come in and say, well, you thought about this? And I think that the key thing is that disintermediation will occur, but those roles and responsibilities are there for a reason. And I think Mark and Alex made a great point, and I think Kelechi was referring to it as well, in that where they land and whether they are achieved via technology, but again, there's legal ramifications to that, or whether existing actors take on new responsibilities. I think that's going to be where we really see this evolve. For Northern Trust, there's a number of opportunity here, right? Tokenization provides that business efficiency. There's new products and revenue streams that come as a result of this. The changing of roles and responsibilities, we're very much comfortable in where we're at the moment. I think when it comes to regulation, get them comfortable with digital assets first before we start saying that we want to be something that we're not. And at the end of the day, custody is what we're good at. It's what we've built our reputation on. So yeah, I definitely see our role evolving, but at this stage, we're very much focused on how do we be a custodian of digital assets.
Thank you, Sean, and we will certainly be keeping our eye on the way the digital asset custody market evolves with our regular guides to digital asset custody. We'll have to stop there because we've run 6 minutes over and I must stop. I'd like to thank our panelists, Alex Kesh from STX, Mark Bearfelt from GK8, Kelechi Bundle from Herbert Smith Freehills, and Sean Mullins from Northern Trust. Just another reminder, our digital asset custody guide is available on the website. You can download it there for free. Our next webinar will explore the opportunities in the carbon credit markets, where there is some scope for tokens to play a part, and I hope many of you will join us then. But for now, it's goodbye from the 5 of us.